Okay, superb. Welcome everybody to this webinar, Portugal Calling webinar from Expats Portugal. It is, of course, US expat taxes. Find out how to get it right. And the experts we have for you this evening are Greenback Expat Tax Services, or Greenback for short. David McKeegan is here. Good evening to you, David.
Hi, thank you.
And you brought some colleagues along with you. You have Kristen here as well to back you up, along with your colleague Alan as well. So welcome to all three of you. And I was going to do an introduction, but I think your presentation here will do that, David. We'll go through the presentation, if you will, and we'll take questions of a universal nature as well in the comments, and I'll do my best to condense those so we don't get too much repetition, and then we'll go to a more personal hands-up session for the premium members thereafter. So thank you for being here tonight with this introduction to US expat taxes. Yes, can be anxiety-provoking, and people want to get this right. So here's how we find out how to do that. David, over to you.
Awesome. Thank you very much. Well, why don't we just dive in and we can talk about what we're going to cover this evening. So we're going to start off, I'll tell you a little bit about Greenback. Then we'll talk about who has to file US taxes. We'll tell you what the tax deadlines are for this year. We'll discuss the foreign earned income exclusion. We'll discuss the foreign housing exclusion, the physical presence test, and the bona fide resident test. And then we'll talk about the foreign tax credit a little bit, the FinCen 114, also known as the FBAR. And we'll talk about the streamlined filing procedure for anybody who might be a late filer. We'll discuss a couple common mistakes that you should try your best to avoid. And then we'll open it up to Q&A. I'll say one thing about the Q&A. Please don't provide any personally identifiable information. My understanding is that this will be recorded and shared on the internet, so you don't want to put anything too personal in there. And we do have the chat open, so if you have questions, Kristen and Alan can help answer those. So a little bit about Greenback. My wife and I started Greenback back in 2009. We've been expats for about 20 years now. I'm speaking to you today from Costa Rica. We live in a little town on the Pacific coast down here, but we've lived all over. We've lived in Europe, we've lived in Asia, we've lived in South America, so currently in Central America. We've got 3 boys. Each of them were born on a different continent. So, you know, that is just really part of the expat life, and, you know, we kind of love it. So a little bit about our company. You know, our goal when we started Greenback was to really help other US expats, and to do that by helping to remove the stress and the hassle of the US tax system and that burden that it puts on people. So our accountants are at the forefront of expertise in US expat tax. We have a very diligent vetting process to make sure that the people we bring onto our team really know their stuff. We try and make it as simple as possible for you to work with us. We try and treat everybody, you know, fairly and with respect. You know, oftentimes we see people come into this process and they're nervous. They don't know what they're supposed to do. They don't know how they're supposed to do it. Maybe they're late on taxes, things like that. So, you know, we try and make sure everybody gets treated very well through the entire process. And, you know, one of my jokes is that, you know, your tax information, it's kind of like your financial underwear. It's something you don't show everybody. Most people don't ever talk about it. And so when you do find a good accountant, you know, you want to build a relationship with them, and you want to make sure that that relationship is maintained over time, because it does become a personal thing between you and the accountant discussing these things. As mentioned, we do have one of our accountants on the call today. We've got Alan on, and he's been an expat. He's lived in Denmark and South Korea, and he's here to help answer questions as well. And we've got Kristen, who's the head of our customer service team, and she can help answer questions as well. So let's just dive right in. We'll talk first about who has to file a tax return. So if you meet these filing thresholds, so if you're single, you have income over $12,550. That's earned income. It's significantly lower if it's passive income. I believe it's just over $1,000 for passive income. If you're married filing jointly, if your income is over $25,100, you have to file. If you're married filing separately and you have income over $5, you have to file. If you're head of household, it's $18,800. And if you're self-employed and you have income over $400, then you have to file a tax return as well. And that's regardless of your status. So what are the deadlines? This year, the IRS opened up on January 24th. So they can start accepting personal tax returns as of January 24th. I don't know if anybody on the call has a business entity, but if you have a partnership, an S Corp, or a foreign trust, those returns are due by March 15th, or you need to file an extension before March 15th. April 15th is what we all associate with as the tax deadline. This year, it's actually pushed back to April 18th because of a holiday in Washington, D.C. But the deadline for the FinCen 114, also known as the FBAR, the Foreign Bank Account Report, is April 15th. But there is an automatic extension in place, which will push it out to October 15th for you. If you're an expat, if you're living overseas on tax day, then you have until June 15th, 2022 to file your tax return and also to file an extension. And if you file an extension, then you can push your tax return due date back to October 17th. Again, usually it's October 15th, but the 15th is a Saturday, I believe, so it rolls to the following Monday. So now we're going to talk a little bit about how expats can minimize the double taxation impact of being a US citizen. So the first and one of the most popular ways to do this is known as the foreign earned income exclusion. And this allows you to exclude up to $108,700 of your foreign earned income from US taxation, and that's for the 2021 tax year. So this is for the taxes you'd be filing this year. This is indexed for inflation. So you've probably read that inflation is creeping up in the United States. So this has been increased to $112,000 for 2022. So the taxes you'll file next year. So you file this using Form 2555, and this is included with your 1040 and whatever other forms or schedules you need to file. Please note, if you're self-employed, the foreign earned income exclusion is applied after your FATCA taxes. So if you're self-employed, you're paying both sides of the self-employment taxes. And so you'd pay the 15.3% before you're allowed to apply the foreign earned income exclusion. Now, in order to qualify for the foreign earned income exclusion, you must pass one of two tests, okay? These two tests are called the physical presence test or the bona fide resident test. So let me explain those a little bit. The physical presence test requires that you are physically present inside a foreign country for 330 days in a 365-day period. Sounds simple enough. People get this wrong all the time. One of the things I hear people say quite often is, I can't be in the US for more than 35 days a year. That is not the same as being physically present in a foreign country for a full 24-hour period for 330 days. When I hear that, I always tend to cringe a little bit and think, please make sure you have a little bit of buffer on both sides. You don't want to play this that close because it's all or nothing. If you are inside a foreign country for 329 days, you get no foreign earned income exclusion if you're using the physical presence test, okay? So remember, full 24 hours inside a foreign country. The other way you can do it is called the bona fide resident test. Now, to qualify for this, you must have lived overseas for at least 1 calendar year and have had no immediate intention of moving back to the United States. So automatically, this excludes anybody who's working overseas as a contractor, because the US government assumes that as soon as the contract expires, you will return to the United States. Now, this one's a little bit more difficult to quantify because it's a lot of gray around who would qualify here. But things like having a long-term lease on your home, having foreign bank accounts that you use to pay utility bills, having your kids in school in the foreign country, these all support the argument that you genuinely live overseas and that you would qualify as a bona fide resident of a foreign country. Okay, the next one I'm going to talk about is the foreign housing exclusion. So the reason I'm talking about this now is this goes hand in hand with the Form 2555, the foreign earned income exclusion. So if your foreign housing costs were at least 16% of the foreign earned income amount, then you can exclude certain household expenses over and above that 16% from your US taxes. So this would qualify for rent. Mortgages don't count, but you can still well, mortgages don't count. The utility expenses, except for telephone, TV, and internet would count. Personal property insurance, homeowners or renters insurance would count. Leasing fees, furniture rental, parking rental, things like that would qualify for this foreign housing exclusion. So in a lot of cases, if you move overseas and you're paying a higher level of rent, you're living in a big city, somewhere like London. I think in London, it's got a pretty high limit. That's where this comes in handy. So that's something you should look at if you're using the foreign earned income exclusion. All right, the next tool that expats have in their tool belt to help them minimize or eliminate their foreign tax or their US tax while they're living overseas is the foreign tax credit. So the foreign tax credit gives you a dollar for dollar credit for income taxes paid to a foreign government. And this is filed on Form 1116 and again is included with your 1040 and whatever other forms you need to file. So people who live in higher tax countries, this could be anywhere in Western Europe, Portugal included. Portugal's tax rate is 48%. So the US, the federal top tax rate is under 40%. So you would have some additional tax you would pay to Portugal. So how does that benefit you? Well, if you use the foreign tax credit, you can build up those tax credits and you can carry them forward. And then you can use them to offset or eliminate future US tax liabilities coming from foreign income. So that's the foreign tax credit. That's probably what most people on this call would be using. I would imagine that most people would be paying a higher rate in Portugal than they would be in the United States. Okay, you may have heard about this, you may not have heard about this. So you'll probably know that inside the United States, when you have a bank account or when you earn interest or dividends or anything like that, you get a 1099. The US government said, hey, this is a great idea. Why don't we roll this out globally? So they created the foreign bank account report. And so now they make everybody globally report all their foreign bank accounts back to the United States. This happened back in the 1970s, I believe. This gets filed with the Financial Crimes Enforcement Center on Form 114. So this is not an IRS form. This is a Treasury Department form, but the IRS is the enforcer of the FBAR, of the FinCen 114. So who needs to file this? Anybody who's had over $10,000 in all of their combined foreign financial accounts needs to file this. Now, where this gets tricky is, let's say you have a checking account and a savings account in Portugal. You transfer over $5,000 from a US account, it hits your checking account, and you move it into your savings account. Well, now you've had $5,000 in your checking account, you've had $5,000 in your savings account. Combined, that's $10,000. So combined, you would need to report that on the FBAR form. Even though you never had more than $5,000 overseas, because you had it in two separate accounts, it has to get reported. That's kind of a crazy example, but again, I think it's important for people to know some of the detail behind this, because that's where people can get in trouble, not filing it when they should have and things like that. Okay. You might have heard of FATCA. So that's the Foreign Account Tax Compliance Act. It's similar to, but it's different than the FBAR. This is for people who have more money overseas. So if you're living abroad and you have foreign financial assets of over $200,000 on the last day of the year, or $300,000 at any point during the year, you'll need to fill out Form 8938. And this is reporting those foreign financial assets. There's a whole long list of which assets are or are not included. And you can find that on the IRS's website. But if you have more money than the FBAR limit, you would have to file this, and you'd have to file the FBAR as well in most cases. Now, I will say that if you're married filing jointly, these numbers double. So the 200 becomes 400, the 300 becomes 600,000. And then if you move back to the US, the numbers drop pretty significantly. So even if you maintain some of those assets overseas, I believe it drops down to 50,000 on the last day of the year and 75,000 at any point during the year. Okay, so oftentimes if I go out and I meet other expats, at some point during the evening, somebody will come over to me and explain to me about this friend of theirs who hasn't been filing their taxes, they haven't been keeping up on things. And as the conversation progresses, it often comes out that it's not their friend, it's them. So generally speaking, what we recommend in situations like that is a program the IRS calls the Streamlined Filing procedure. So this is a way for people to become compliant with the IRS with no late filing penalties and no FBAR penalties. And what you need to file is 3 years of back tax returns, and you need to file 6 years of back FBAR forms. And you also have to sign an affidavit certifying that you didn't purposefully or willfully avoid filing your US taxes. So this is for people who didn't know, or they got behind and they didn't know how to catch up, or they made a genuine mistake, not people that are trying to avoid taxation and not people who are trying to hide assets overseas. So if you know anybody who hasn't been filing that wants to get caught up, or if you are somebody that hasn't been filing and you'd like to get caught up, have a look at the Streamlined Filing procedure. That's probably going to be a good option for most people in most cases. Okay, so the next thing I'd like to talk about is some common mistakes that expats make that can end up costing you a lot of money. So one of the most common things we see is someone moves overseas, they start working, they start living their life overseas, and part of that is saving money and investing. And if you start investing the wrong way when you're outside the US, you can get in trouble very, very quickly. So one of the wrong ways to do this is investing in foreign mutual funds. even if those funds are with a name you recognize, like Vanguard or Fidelity, they may not have the same reporting requirements that the IRS requires for it to be considered a mutual fund. If that's the case, it'll be classified as what's called a PFIC, or a passive foreign investment company. And this creates a whole lot of filing requirements, paperwork, and reporting, and you lose a lot of the benefits of investing in mutual funds and things like that. So be very, very careful about how you're investing while you're living overseas. The next one I'll talk to is not keeping track of the number of days that you were abroad. So I mentioned this earlier, but the foreign earned income exclusion is all or nothing. If you're overseas for 329 days, you don't get it. Now, what I will say is that it's a flexible 365-day period. So if you miss it for part of 1 year, maybe you can stay abroad a little bit longer the next year and catch a piece of it that way. So there is always that option, but you need to keep track of your days. You actually have to report that on your tax return. So pay attention to that and make sure that you're staying compliant with being inside the foreign country for 330 days if you're planning on using the foreign earned income exclusion. The next one I'll mention is trying to exclude earned income from the United States with the foreign earned income exclusion. So let's say you have a virtual position, you live in Portugal most of the year, but you go back to the US for 3 or 4 weeks to visit friends and family. If you're working and earning money on that trip, then that's income that wasn't earned abroad. That's income that's earned in the United States. So you would have to pay US income tax on that income. The next one we have on here is trying to apply the foreign tax credit to income that's been excluded using the foreign earned income exclusion. So you can use both the foreign earned income exclusion and the foreign tax credit. You can use one or the other, but you can't use them both on the same money. So, yeah, by way of a simple example, if you earn $100,000, you can use the foreign earned income exclusion to exclude the whole amount. If you earn $200,000, you can use the foreign earned income exclusion on $100,000 of it, and then you can use the foreign tax credit on the other $100,000. So let's say you pay 10% tax on that other $100,000, you would have a $10,000 tax credit that you could use on your US tax return to offset the tax on that other $100,000. The last one I will just briefly mention on here is, depending on your situation, and this becomes more relevant the more complicated your situation is, there might be something in the US-Portugal tax treaty that would help you. We had a quick look at it before this call. There's nothing glaring that really jumped out at us, but depending on your situation, depending on how complex your situation is, you should consult that tax treaty just to make sure there's no better or more optimized way for you to be filing your taxes, or take a treaty position to make sure you're not getting double taxed. So the last slide I'm just going to talk to very briefly is a little bit about how we work. So, if you sign up on our website with us, you'll be paired with one of the accountants on our team, so a CPA or an IRS enrolled agent. Everybody has over 5 years experience working with Expat Taxes, and you'll be communicating directly with that accountant. You'll share your tax information with the accountant. We have an online system where you can put everything, all your details in, you can upload your files. It's all bank grade security. So, we're using major systems, Salesforce, Box, things like that to make sure that your data stays protected. We will provide a price estimate based on what's needed. on all of our fees. We have flat fee pricing. It's all listed on our website. One of the things we really wanted when we started this process was not to surprise people with how expensive or not expensive it would be to prepare their taxes. We were actually living in London at the time we started this business, and I was calling around trying to get somebody to help us with our taxes at the time, and got price estimates that were all over the place, from low thousands of pounds up to multiple tens of thousands of pounds. And so part of us starting this business was to avoid that and just let people know and understand how much they would be paying from the get-go. Then, our accountant will start working on your return, trying to make sure that you get the maximum savings deductions. And then finally, we will send you a draft of the return, and you'll review that and say it's okay. Then we'll send you the invoice, and then we e-file the tax return for you. There are a couple cases where we can't e-file a tax return. Those are usually because of the IRS, not because we're trying to be difficult. And in those certain circumstances, you would need to mail the tax return in yourself. Okay, so I think we can open it up to Q&A now. And Alan, I'm going to have a sip of water and let you start with some of the Q&A.
David McKeegan of Greenback, thank you so much for that. That's really good. Really enjoying the underwear analogy that you kicked off with. Excellent acronym management as well. And thank you to the team, to Alan and Kristen for working in the chat. So really, it may be that many of the questions have been answered, but do please, if it hasn't been answered, which I'm surprised by because Kristen and Alan have been working hard back there, do pop it into the chat, if you will, one more time so we can address that. Alan, did you pick up on anything that you did want to talk about?
Well, there were a couple of questions about the foreign earned income exclusion. There was a great question out there about, is it just for one tax return, or does each person get a foreign earned income exclusion if they file jointly? And that answer is yes. If you're married filing jointly, both spouses can each exclude for 2022 up to $112,000 of their salary and pay zero tax on that. That was an excellent question.
Yes, there were some great questions tonight, weren't there? Anything else that caught your attention that we can answer in a general, universal way like that?
Well, there are a couple of... go ahead, Alan.
I was going to say there were a couple of questions about FBARs. I just want to say, like in general, if you're not sure whether you're supposed to report something or not, just report it. There's no extra penalties or fees or anything by the federal government for reporting too much on a foreign bank account report, but there are huge penalties for not reporting accounts when you should. And the name is a little bit misleading, it's foreign bank account, but you do need to report all of your bank accounts, most of your pension and retirement accounts, investment accounts, and any other kind of financial accounts, not credit cards or mortgage loans or anything like that. But when in doubt, just report it.
And very interesting to see the amnesty that was there, where you could streamline your filing. I think that the term was. How new is that?
Oh, well, it's been around for a number of years, and there are various different programs. And what's so good about these amnesty programs is that if you come forward, you get reduced penalties or penalties waived altogether. So one of the most common one is the Streamlined Offshore Filing Program that's still going on. And then this could close at any time. And what's so great about this is if you just, for example, a lot of people simply don't know that they've had to file tax returns while they're living overseas. There was only a couple of countries that require that, right, Dave? There was North Korea and Eritrea.
Yep, yeah, exactly.
That require their citizens to file no matter where they live in the world. Well, under this program, if you haven't filed for a number of years, you can fall under the Streamlined program, and you just have to do a couple of things. So The last 3 years of tax returns that are late, you have to file those. And if you owe any tax on that, you have to pay the tax. A lot of expats don't owe tax though. And then you have to file the last 6 years worth of FBARs, or foreign bank account reports, if those are delinquent. And Dave mentioned a little bit about this in the earlier slide. You also have to fill out an affidavit, basically a letter stating that you simply didn't know you had to file tax returns, and give a little bit of information and advice about that. If you put all of that together, send it into the IRS, generally they'll just waive all of the penalties. And if, for example, you haven't filed tax returns for 5 years and you're filing the 3 late years, then those past 2 years or any other past years are basically forgiven for the most part. So it's an excellent, excellent program. We file a lot of those for people living overseas because, again, people just simply aren't aware that they had to continue filing tax returns while living overseas.
Interesting company to be in, Eritrea and North Korea there. Thank you, Mark. How is Social Security tax for foreign residents and for IRA distributions? Forgive me, I don't even know what I'm talking about when I mention that to you, but you will.
Yes, well, IRA distributions, that's a type of a retirement plan that people put money into for different tax reasons in the US, and they get various tax benefits for that. And Social Security is basically like, I believe they call it NI in the UK. Is that correct, Dave? It's basically, a government payments to citizens normally because they reach an old age or they're disabled or something along those lines. So everything, all of your income is taxable if you're a US citizen. And most of the benefits come from when you have a salary and you're earning money, then you get a lot of benefits. You get to exclude a large portion of it. On some other income, such as these retirement incomes that you receive, the best way to hopefully reduce the US tax that you owe, maybe to zero, is to use the foreign tax credit. And just to kind of give you a brief explanation of what that is, that's when you have to pay income tax to one country such as Portugal, right? And you do your US tax return, you figure out how much tax you owe, and you are able to reduce the tax that you owe to the US based on the amount you pay to another country. That's the best bet to try to reduce any tax that you have on any type of retirement or social benefits, social welfare income that you get while living overseas.
Thanks for that, Alan. Max, appreciating your advice. When in doubt, just report it. He says, great advice. Do the right thing and sleep well. That's good advice. That's good life advice, isn't it?
Yeah, absolutely.
Stephen, do you help with, this is quite serious. Do you help with renouncing US citizenship because you're not coming back to the US? I wouldn't have thought you did, but you do, don't you? Kristen is saying. Why would someone? And someone can do that to not then, obviously, if you're no longer a citizen, you don't have to file a tax return, presumably. Yes,
that's correct. So anyone who falls within the US tax system can renounce if they want. And it's not as simple as turning your passport in at an embassy or something in regards. There's a process for it. Some US citizens do it. You commonly see it for people who receive green cards, which is a special immigration status, that have lived in the States for a number of years and they're retiring. They're going to move back to their home country and give up their green card. And there's a few other situations as well. But, if you think about it, if you're under the US umbrella's tax system, they're not going to necessarily want you out so easily. So if you're interested in that, I would suggest having a consultation with myself or someone else at Greenback. We could walk you through the process. We could explain what the exit tax is. So you might not be able to just get out of the US tax system and leave. You might have to pay kind of a large tax or not upon giving up your US citizenship. There's just a lot of variables to it. A lot of things to consider. I've seen a lot of articles and things on the internet that say, it's so easy. Yeah, just do it, give it up, be done with it. You never have to file tax returns, never have to pay US taxes. Unfortunately, it's not nearly that easy.
As we may have suspected, Desiree asked a good question. It's like the penny dropping with this, or not, as the case may be. But this isn't a tax question. Thank you for this. But if you renounce US citizenship, can you still get Social Security? It's like, I don't want to be a citizen anymore, but can I still have my money? What's the answer to that?
Well, Social Security, like I was saying, it's basically a government benefit for reaching a certain age or being disabled, and you do not have to be a U.S. citizen in order to receive it. In order to receive it, you have to work in the U.S. for basically 10 years and pay into the system. Okay, they don't have to be 10 consecutive years, but once you qualify, it doesn't matter if you came to the U.S. as a non-citizen, if you became a citizen while in the U.S., if you left the U.S. and gave up your citizenship. Once you qualify, regardless of what your citizen classification is, you're entitled to it. But it does change a little bit. If you do renounce, then you're basically going to have to pay about 30% flat tax on those Social Security benefits. It really works out to be more about 25.5%. So in a lot of cases, when people want to renounce their citizenship for tax purposes, it winds up that they actually pay more taxes than they would have for all of the income they earn from the United States, such as from Social Security or retirement savings from a 401k account or IRA or different things like that. So for the vast majority of people, for tax reasons, it doesn't necessarily make sense to renounce.
They really don't want you to go. That's great. Thank you for answering that. And perhaps we should reiterate before we come to a conclusion on this part of the call anyway. Regarding Portuguese and US tax returns, you need a Portuguese-based accountant to do that, financial accountancy professional here in Portugal. And you, for example, for the US side, you don't do both, do you? It has to be done by a Portuguese-based person this side, and you do the US stuff, strictly speaking.
That's correct. We just handle the U.S. side and U.S. side only. That's more than enough. And that includes all 50 states and DC and the territories and et cetera. We can try to give you whatever guidance that we can, but, the U.S. tax laws, that's what our specialty is. And if you do have some tax issues, you really should see a local advisor to get the right advice.
Excellent. Thank you for that clarification. And we're very well represented tonight, people from all over the United States. Thank you for being here. So before we end on this segment, before we go to more personal questions, is there anything you want to add, Alan or David or Kristen?
No, just thank you all for listening.
Yes, thank you all very much.
That's most excellent. So info@greenbacktaxservices.com, or go and sign up, as David was saying, greenbacktaxservices.com. Thank you very much for that.